On March 15, 2023, in New York City, a significant incident unfolded within the realm of global trading platforms operated by several leading financial institutions. The primary actor in this scenario was a consortium of top-tier trading platforms, collectively known as Trademaster Group. This consortium utilized a sophisticated digital infrastructure designed to facilitate high-frequency trading and manage vast transactions in real time. The core of their system relied on a complex network of algorithms and application programming interfaces, APIs, that integrated across various financial markets. In the weeks leading up to March 15th, management at Trademaster Group made a critical decision to postpone a routine software update intended to address vulnerabilities identified in their trading ecosystem. Factors such as budget constraints, projected downtime, and a recent overhaul of operational protocols contributed to this decision. As a result, crucial patches that were designed to secure the trading software from known exploits remained unimplemented. The delay escalated as various teams within the organization failed to effectively communicate the serious implications of this decision, resulting in a widespread misconfiguration of the digital environment. The initial failure became apparent on the morning after the update was postponed. Cybercriminals exploited the known vulnerabilities in the trading platform software. Utilizing an access vector that capitalized on insufficiently secured APIs, attackers gained entry into the system. This breach occurred due to a combination of weak controls in user permissions and inadequate logging practices, which allowed unusual activity to go undetected for critical hours. The compound effect of these oversights created a perfect storm that no internal monitoring system was prepared to handle. By mid-afternoon on March 15th, the first measurable impact emerged. An analysis revealed that real-time trading activities across the affected platforms had begun to exhibit anomalies. Within 2 hours, over $10 billion in transactions experienced disruptions. Market prices for numerous equities fluctuated wildly, resulting in significant losses for institutional investors. Estimates suggested that shares worth nearly $2 billion were mistakenly sold at a fraction of their intended values, leading to chaotic trading conditions. As the situation escalated, reports of malfunctioning trading algorithms proliferated, prompting widespread concern among traders and analysts alike. Inside the organization, confusion reigned as the incident response team convened via internal email channels and incident channels. Initial assessments indicated that the technical failure was isolated, encouraging employees to focus on partial fixes rather than a complete system review. Some team members mistakenly assumed that the issues were related to external market pressures, rather than an internal vulnerability exploitation. This misjudgment delayed a cohesive and thorough response plan, allowing the incident to unfold unchecked. On the external front, the first signals of trouble materialized through user reports flooding social media and online trading forums. Concerned traders began sharing screenshots of the irregular trading behaviors they were witnessing, citing error messages and transaction failures. Monitoring alerts from various financial news platforms documented increasing transaction failures, with minor media mentions emerging that hinted at something more significant occurring within the trading ecosystem. However, without a clear picture of the crisis, media outlets remained hesitant to portray the event as anything more than a temporary glitch. As the hours passed, key figures at Trademaster Group began to reassess the situation. An emergency meeting was convened between IT security personnel and upper management. Discussions centered around the efficacy of the existing security protocols and the ramifications of the delayed software update. Despite initial attempts to apply patches developed prior to the incident, these efforts fell short due to the complexity of the interlinked systems. New vulnerabilities surfaced as the team attempted to mitigate the cascading failures, leading to even greater delays and complications in restoring normal operations. With the crisis beginning to unfold, external monitoring systems continued to alert investors and regulators about the unexpected trading behaviors. Some analysts suggested that global markets could soon face a downturn as panic spread. Observers noted that the ramifications extended far beyond immediate financial losses. They could reshape investor confidence and regulatory scrutiny in the trading industry. Those working within Trademaster Group faced mounting pressure, knowing that any misstep now could lead to irreversible damage not only to their reputation, but also to the stability of the broader financial ecosystem. As the day drew to a close, the initial technical failure escalated into a full-blown crisis. An investigation was initiated within the organization to determine the full scope of the breach and to identify any other potential weaknesses exacerbated by the failure to perform the scheduled software update. The gravity of the situation weighed heavily on management, and dissatisfaction echoed through their internal communications. As teams scrambled to gather data and prepare briefings, the looming question of accountability became more pressing. Fingers were being pointed, and the clarity needed to move forward was sparse. The chaotic scene inside Trademaster Group highlighted the fragile nature of the interconnected trading environment. Each passing hour saw the situation deteriorate further, as the initial miscalculation transformed into a crisis that threatened to reverberate throughout the global financial markets. Unseen consequences loomed on the horizon, and the organization remained in a precarious position, caught between damage control and the mounting reality of their unprecedented failure. As communications continued to falter within Trademaster Group, external parties began taking notice of the ongoing dysfunction. Market exchanges implemented temporary trading halts on several assets, hoping to stem the tide of panic. However, as international markets remained interconnected, the fallout quickly spread beyond the company's immediate scope. A ripple effect ensued, leading to mass sell-offs in other trading platforms and significant regulatory inquiries initiated by financial authorities. Concerns over the integrity of major trading systems prompted swift action from the Securities and Exchange Commission, which began to investigate Trademaster Group's operations in the wake of the incident. Despite the company's assurances of a rapid resolution, the flaw in security measures remained unaddressed, and erroneous trades continued to amplify. By the end of the following week, reports indicated that the total losses exceeded $4 billion, with thousands of transactions mistakenly executed or canceled, leading to further instability in stock prices across multiple sectors. The crisis drew attention not only from investors, but also from the media, which began an in-depth analysis of the systemic failures that led to the debacle. On the public front, details emerged through various news outlets, and whistleblower reports hinted at the inadequacies in Trademaster Group's response mechanisms. The New York Times published an exposé outlining internal communications that revealed warnings about potential vulnerabilities, and compromised algorithms had been ignored. The report included leaked chat logs detailing discussions among IT staff about the urgency of the software updates prior to the incident. By this point, it was evident that miscommunication and oversight in prioritizing cybersecurity had played a significant role in facilitating the crisis. The phenomenon of the banking chain reaction took hold as institutions began reevaluating their reliance on affected trading platforms. As media coverage intensified, investors clamored for explanations. TradeMaster Group authorized a public statement asserting their commitment to rectification and transparency, announcing their ongoing efforts to repair the system and restore user confidence. However, among the community of traders and financial analysts, doubt about the integrity of the platform deepened. Within weeks, TradeMaster Group faced an escalation of penalties from regulatory agencies. The SEC issued formal subpoenas, demanding comprehensive documentation of security audits, incident response plans, and proof of compliance with previous regulatory recommendations. Law enforcement agencies also became involved in investigation procedures, scrutinizing internal practices that contributed to the incident. Efforts to enhance security protocols were rapidly implemented, though many observers feared these measures would merely serve as superficial security theater rather than effective solutions. Simultaneously, asset recovery teams were mobilized with hopes of reclaiming the billions lost during the upheaval. However, many victimized traders confronted obstinacy regarding financial recoupment. Various laws and regulations limited the power of firms to recover losses stemming from systemic failures. Lawsuits began flooding courts, with class action suits being filed against TradeMaster Group from aggrieved investors seeking recompense for their losses. As legal proceedings unfolded, the company's workforce faced scrutiny from not just regulators, but also investors who questioned the management decisions leading to this unprecedented reactive crisis. Reports circulated that some high-ranking officials within TradeMaster Group had begun preparing for potential resignations or exits from the company, recognizing that the reputational damage might threaten the organization's long-term viability. In a strategic pivot, TradeMaster Group initiated partnerships with cybersecurity firms to conduct a thorough assessment of their technology infrastructure. The newly implemented emergency changes aimed at patching vulnerabilities took center stage. Yet it was met with skepticism, as many analysts suggested that the cultural weaknesses within the organization far exceeded technical shortfalls. By mid-year, the combination of regulatory challenges, mounting lawsuits, and eroded investor confidence culminated in a devastating outcome for TradeMaster Group. The company's stock plummeted, resulting in a significant loss in its market capitalization, with estimates indicating a staggering decline of more than $10 billion. By late July, the cumulative financial strain forced TradeMaster Group to declare bankruptcy. The company sought to secure a federal bailout, but was met with political resistance against using taxpayer dollars to support a firm that had demonstrated clear negligence. As TradeMaster Group unraveled, the global trading platforms began implementing sweeping policy changes aimed at preventing similar incidents from occurring in the future. These included mandatory updates to trading algorithms, enhanced cybersecurity protocols, and greater transparency in incident reporting measures to both investors and regulatory bodies. The crisis remains a cautionary tale of negligence and oversight within interconnected financial systems. By December 2023, TradeMaster Group officially dissolved, and its assets were liquidated under the supervision of the bankruptcy court, definitively marking the end of an era for a trading platform that once wielded substantial influence over global finance. Final status. As of December 31st, 2023, TradeMaster Group was formally dissolved and declared bankrupt, facing no possibility of operational resurgence.